Want to unlock the secret to long-lasting wealth? Warren Buffett's proven strategies can change your financial future forever. Don't miss out on these timeless lessons. Your path to financial freedom starts with understanding these powerful principles. Warren Buffett's secret to smart investing. Warren Buffett, one of the world's wealthiest individuals, has always emphasized the importance of investing within your circle of competence. This simple yet powerful strategy has guided him to immense success. According to Buffett, understanding what you're investing in is crucial. Buffett advises that investors should stick to industries or businesses they truly understand, which allows for smarter, more informed decisions. He believes that trying to venture into unfamiliar areas can lead to unnecessary risks. For instance, Buffett famously avoided technology stocks during the 1990s tech boom, as he didn't fully grasp the market. Instead, he focused on companies with predictable earnings, like Coca-Cola and See's Candies. His consistent success proves that understanding what you invest in is far more valuable than trying to chase the next big trend. In simple terms, Buffett's strategy is about playing to your strengths. By investing only in areas you understand, you lower the risk of making costly mistakes. This mindset continues to be a cornerstone of his wealth-building approach, showing that knowledge and patience can lead to long-term success. Warren Buffett's timeless wisdom. Warren Buffett has always advocated for investing in high-quality businesses at a fair price. This principle has been a guiding light in his legendary investing career. Rather than chasing after the cheapest stocks, Buffett stresses the importance of focusing on companies that have strong fundamentals, things like consistent earnings, solid management, and a competitive edge. For example, in 1988, Buffett made a major investment in Coca-Cola, paying a price that many at the time considered high. However, he saw the company's enduring brand value and potential for long-term growth. Over the years, this investment turned out to be a massive success. Buffett's point is clear. Buying a great business, even if it's not a bargain, can be far more lucrative than purchasing an undervalued company that might not have the same potential for success. Buffett's strategy teaches investors to focus on long-term value, not short-term discounts. By looking for quality and ensuring the price is reasonable, you can build a portfolio that stands the test of time. Warren Buffett's path to lasting wealth. Warren Buffett has always been a champion of long-term investing, and this strategy has played a huge role in his extraordinary wealth. Rather than jumping in and out of stocks, Buffett believes in holding investments for extended periods, sometimes for decades. This approach allows your money to grow through the power of compound interest. Buffett's investment in American Express in the 1960s is a perfect example of his long-term vision. Despite initial challenges, he held on, and over the years, his patience paid off as the company's value skyrocketed. Buffett's philosophy is that by sticking with great businesses and allowing them time to grow, you can benefit from their long-term success. Moreover, Buffett's advice encourages investors to avoid reacting to short-term market fluctuations. By staying focused on the long haul, investors can ride out market ups and downs, ultimately growing wealth steadily. Embracing a long-term perspective allows you to take advantage of market growth, and just as importantly, gives you the peace of mind that comes with not constantly chasing after the next big thing. Warren Buffett's strategy for seizing opportunities. Warren Buffett has always stressed the importance of maintaining sufficient cash reserves to navigate uncertain times and take advantage of opportunities. His philosophy revolves around the idea that having cash on hand provides financial flexibility, especially when markets are volatile. Buffett is known for keeping large amounts of cash within his investment company, Berkshire Hathaway, which allows him to be prepared for sudden market downturns. During the 2008 financial crisis, Buffett demonstrated this strategy when he used Berkshire's cash reserves to invest in Goldman Sachs and General Electric at a time when many others were paralyzed by fear. This was an opportunity to buy high-quality companies at discounted prices, and Buffett's foresight paid off significantly in the long run. By keeping cash reserves, Buffett ensures that when everyone else is rushing to sell, he can step in and buy. This strategy not only helps weather tough economic times, but also positions investors to seize lucrative opportunities that others might miss. Having cash ready is not about being overly cautious. It's about being able to move quickly when the right deal arises. Warren Buffett's approach to maximizing returns. Warren Buffett has always been a strong advocate for minimizing investment costs to maximize returns. In his view, even small fees can erode long-term profits, which is why he advises investors to avoid unnecessary expenses. One of his key strategies for reducing costs is by investing in low-cost index funds, particularly for those who don't have the time or expertise to pick individual stocks. Buffett's famous advice is to keep it simple. In his 2013 letter to Berkshire Hathaway shareholders, he recommended investing in low-cost index funds for most people, emphasizing that they are the most cost-efficient way to build wealth. By minimizing fees and trading costs, investors can keep more of their returns, which adds up significantly over time. Buffett's own investment strategy involves buying and holding quality businesses for the long term, avoiding frequent trading that would incur high commissions and taxes. His approach teaches that, while some costs are inevitable, being mindful of them is key to building lasting wealth. Keeping expenses low helps you retain a larger portion of your investment returns, contributing to greater financial success over time. Warren Buffett's path to true wealth. Warren Buffett has always prioritized financial independence over the pursuit of material wealth or status symbols. While many chase luxury cars, designer clothes, and expensive homes to show off their success, Buffett has famously lived a relatively simple life, despite his vast fortune. He still resides in the same home he bought in 1958 for $31,500, a clear demonstration of his philosophy that accumulating wealth should be about freedom, not showing off. Buffett teaches that financial independence is about having the freedom to make choices without being burdened by debt or the need for validation through material possessions. This mindset allows individuals to focus on long-term wealth building rather than short-term displays of success. Through his example, Buffett shows that true wealth is measured not by what you own, but by the financial freedom you have. By resisting the temptation to flaunt wealth and focusing on saving, investing, and growing your money, you can build lasting financial security and enjoy a life free from the pressures of consumerism. Warren Buffett's strategy for protecting wealth. Warren Buffett has long understood the dangers of inflation and how it can erode the value of money over time. In fact, he often advises investors to focus on assets that can outpace inflation, such as stocks or real estate, rather than holding cash, which loses value in an inflationary environment. Buffett's investment in companies with strong brand power and consistent earnings, like Coca-Cola and American Express, is partly driven by the belief that these businesses can raise prices to keep up with inflation. By focusing on companies that have the ability to increase their profits over time, Buffett ensures that his investments not only protect against inflation, but also grow in real value. In his 2011 letter to shareholders, Buffett warned about the dangers of inflation and the importance of investing in assets that can keep pace with rising costs. He believes that stocks represent a hedge against inflation because they tend to appreciate over time, unlike cash or bonds, which lose value when prices rise. Understanding inflation's impact is key to making sound investment decisions. By investing in inflation-resistant assets, Buffett's approach ensures that your wealth maintains its purchasing power over the long term. Warren Buffett's approach to safe investing. Warren Buffett has always emphasized the importance of avoiding speculative and reckless investment behaviors. For him, investing is not about gambling on short-term trends or chasing get-rich-quick schemes, but about making informed decisions based on solid research and long-term value. He warns against the temptation to follow market fads or jump into investments simply because everyone else is doing it. One of Buffett's most famous quotes is, "Be fearful when others are greedy and greedy when others are fearful." This advice reflects his approach to staying calm during market hype or crashes. In the 1990s, many investors poured money into tech stocks during the dot-com bubble, hoping for fast profits, but Buffett avoided the frenzy. His cautious, value-focused investing approach saved him from substantial losses during the market crash that followed. Buffett's strategy teaches that avoiding speculative behaviors is key to long-term success. By investing based on fundamentals rather than short-term speculation, you protect yourself from risky behavior and ensure a safer path to wealth. His disciplined, Patient approach proves that slow and steady wins the race in investing. Warren Buffett's formula for continuous growth. Warren Buffett has always emphasized the importance of learning from mistakes and using past experiences to improve future decisions. One of the key elements of his success is his ability to reflect on his failures and adapt his strategy accordingly. Buffett has made his share of mistakes throughout his career, but he sees them as valuable learning experiences rather than setbacks. In 1993, Buffett admitted his mistake in investing in Dexter Shoe Company, a company that ultimately failed. He wrote in his 1993 annual letter to shareholders that this $400 million loss was his biggest investment mistake. However, rather than shying away from it, he used it as an opportunity to learn. Buffett has often stated that the key to becoming a better investor is acknowledging errors and using them as stepping stones for improvement. Buffett's ability to learn from his mistakes has allowed him to continuously refine his investment strategies over the decades. He encourages investors to avoid repeating the same errors by analyzing past decisions and using those lessons to make smarter, more informed choices moving forward. Embracing mistakes, learning from them, and adapting is a fundamental part of Buffett's approach to sustained wealth building. Warren Buffett's key to confident investing. Warren Buffett's investing success can largely be attributed to his principle of staying within his circle of competence. This means focusing on industries and businesses that he fully understands, avoiding investments in areas where he lacks expertise. For Buffett, this approach allows for confident, well-informed decisions that reduce unnecessary risk. One of the clearest examples of this philosophy was Buffett's initial reluctance to invest in technology stocks, particularly in the 1990s when the tech bubble was expanding rapidly. Despite missing out on the early boom, Buffett stuck to what he knew: businesses with strong, predictable earnings like Coca-Cola and Wells Fargo. By staying within his circle of competence, he avoided the speculative risks that many others faced during the tech boom. Buffett's advice to investors is simple: know what you know and don't invest in things you don't understand. This approach has allowed him to navigate complex markets with confidence. By sticking to what he understands, Buffett has successfully built a massive fortune, proving that investing wisely means recognizing your strengths and limitations. Feeling left behind? Don't let the chance slip away to take control of your wealth. Hit subscribe and stay tuned for our next video. Financial freedom: how to retire in your 30s or 40s. Get ready to transform your financial life. Don't miss it.